It can be overwhelming to choose a high-quality investment when given literally thousands of different options. When investing for retirement, you have so many choices it can be difficult to decide which direction to go. What is going to provide not only growth, but stability and isn't going to drain your savings in the form of fees? There's a lot to consider, and the decision you make could mean the difference of earning market-beating returns over your career or gambling your life savings. These choices will lead you in the right direction to choosing high-quality investments. These ETFs are not only great options that will help you reach financial independence, they provide favorable returns and have very low fees. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Vanguard Growth ETF, VUG. This fund is geared towards growth, which is ideal for younger investors with a long time horizon and higher risk tolerance. It tracks the CRSP US Large Cap Growth Index, which selects large and mid-cap stocks with growth characteristics. Investing in this fund means much of your money will be directly in fast-growing companies like Apple, Microsoft, Amazon, and Tesla. As the saying goes, higher risk, higher reward, meaning this fund will perform better in upward trending markets and worse than average during down markets. Over a long period of time, returns should be higher than what you'd earn with the general S&P 500. Technology is the largest sector, followed by consumer cyclicals, communications, and healthcare. Apple is the largest holding, followed by Microsoft, Amazon, and Tesla. As is typically the case with growth stocks, the dividends are small and often non-existent, giving the fund a dividend yield of 0.7%. The expense ratio is 0.04%. Vanguard Value Index ETF, VTV. VTV tracks the CRSP US Large Cap Value Index, holding over 300 different companies. It chooses stocks based on multiple value factors, or stocks that seem to be trading at a discount relative to their value, unlike growth investing, which is more geared towards selecting stocks with a high future growth rate. Think of value investing like buying a steak at the store, which usually retails for $12, on sale for $8. Value investing is the strategy that Warren Buffett employs and has allowed him to build a net worth of about $100 billion. Buffett calls this cigar butt investing, basically buying beaten-down companies. The largest sector allocation is healthcare, followed by financials, industrials, and consumer defensive. United Health, Berkshire Hathaway, which is Buffett's company, Procter & Gamble, and AbbVie are among the top 10 holdings. The dividend yield is under 3%, and the expense ratio is 0.04%. Vanguard S&P 500 ETF, VOO. When someone references the market, they're most likely referring to the S&P 500, and this has come to be one of the main indicators of the U.S. economy. Investing in the S&P 500 is a great choice for many reasons. When you invest in this index, you're purchasing hundreds of different companies across all sectors of the market, giving you instant diversification. Before a company can be added to the S&P 500, it must meet various requirements to ensure it will be profitable for investors. Basically, the company must be a certain size, it must be liquid, and it must have positive earnings in addition to other factors. The returns are nothing to scoff at either, with the average annual return since it first began through the end of 2021 being nearly 12%. Technology is the largest sector by far, followed by healthcare, financials, and consumer cyclicals. The top 10 holdings include Apple, Microsoft, Amazon, Tesla, and ExxonMobil. This is one of the simplest, easiest, and most common investments for the reasons mentioned, and it's often all that's needed to achieve a comfortable retirement. For these reasons, this might be the best single investment you could make. VOO has a market average dividend yield of about 1.7% and an expense ratio of 0.03%. Vanguard Total Stock Market ETF, VTI. Vanguard Total Stock Market ETF takes diversification to a new level with 4,000 different U.S. holdings. Unlike the S&P 500, which only includes large companies, VTI includes small, medium, and large companies. Many investors like being exposed to smaller companies because they have more upward potential when compared to behemoth corporations who remain largely stagnant. It's much easier for a small business to double or triple their sales when compared to a huge company like Apple, whose growth is limited. Even though they provide more upward potential, they are more volatile and they have a higher chance of losing money and going out of business when compared to a huge company that has manageable levels of debt and has been around for decades. Technology is the largest sector, followed distantly by healthcare, financials, and consumer cyclicals. Within the top 10 holdings are Apple, Microsoft, Amazon, and Berkshire Hathaway. The dividend yield is about 1.7% and the expense ratio is 0.03%. Schwab U.S. Dividend Equity ETF, SCHD. This is a favorite among dividend investors for the fact that its primary focus is high-quality income-producing stocks. It's important to be careful when buying stocks and funds for dividends because these potentially profitable investments are often disguised as yield traps. This occurs when a very high dividend yield attracts investors to a potentially troubled investment. Think of this as a stock that has a very high dividend yield but has been trending downward for many years, usually due to the company's fundamentals. SCHD only holds stocks that have dependable dividends, specifically 10 years of consecutive dividend payments. The focus on high-quality companies in addition to dividends should provide healthy growth as well as income. With over 100 stocks, the largest sector allocation is financials, followed by industrials and technology. Among the largest holdings are Merck, Amgen, IBM, and Coca-Cola. The dividend yield is about 3.5% and the expense ratio is 0.06%. Vanguard Total World Stock ETF, VT. This ETF tracks the FTSE Global All Cap Index, which covers both well-established and developing markets. It invests in both foreign and U.S. stocks, unlike many of the popular funds which are concentrated in just the United States. It has nearly 10,000 different holdings, with about 40% of them being in foreign markets, but it still has many of the same holdings as U.S. funds, such as Apple, Microsoft, United Health, and Berkshire Hathaway. Technology is the largest sector, followed by financials, healthcare, and consumer cyclicals. The fund has many stable holdings that can be found in the S&P 500, but investors also receive international exposure, which provides extra diversification, and they can take part in the growth of emerging markets. The dividend yield is over 2%, and the expense ratio is just 0.06%. As you may have noticed, these funds vary slightly, but many of them share the same holdings and have similar sector allocations. Most of these are Vanguard funds, which are known for some of the lowest expense ratios. They are most likely equivalents offered by various companies because most of the major investment firms offer the same selection. When you choose a high-quality ETF that's well-diversified and holds class-leading companies with solid fundamentals, there's not much else you need to do. By investing into the fund regularly as prices rise and fall, you should see sizable growth that will help your investments compound. A small selection or even one high-quality ETF will be all you'll ever need to become very wealthy.